Bank hybrids under the spotlight again after a big sell-off following S&P's announcement that it won't rate them anymore. Many investors believe that decision will force institutions to sell hybrids as they're only allowed to invest in rated securities. For more on this, Brad Newcombe, Senior Research Analyst at FIIG Securities, joins me now in Brisbane. Brad, top of the morning to you. Looking onto your website into that very issue, you say we believe there is negligible change in risk over that decision. If so, why so?
Yeah, that's right, Carson. Nothing in relation to these hybrids has changed. I mean, they're exactly the same securities, same credit risk, same value. The only thing that's changed is that S&P and Moody's have both made regulatory decisions or decisions relating to regulatory actions, and they're going to reduce their ratings in the case of Moody's, and S&P are going to stop rating retail products altogether.
But notwithstanding that, the very instance of a pull out of the market, what you say has triggered, what, an unwarranted sell-off or a no-option sell-off?
Yeah, it could be a no-option sell-off. Certain investors, including institutions and fund managers, have mandates where they're required to hold securities of certain ratings. And if S&P are no longer going to rate these securities, and Moody's are also going to downgrade these securities, then there could be a sell-off in anticipation of these mooted changes coming in from 1 January next year.
Let's talk about yields meanwhile. In this environment, what you're saying, we've seen pretty steep rises based on what?
Yeah, based on the sell-off of securities, the yields on these hybrids have risen dramatically. The main example is probably a security called the Westpac Trusts. In the last couple of weeks, it's been sold down from the mid to high $80, and it's down trading around about $82 now. And that's resulted in an increase in its yield or its spread over bank bill swap rate to about 5% from in the 3% range previously.
As though, I mean, if we're talking about these instos bailing, who's going to take their place?
Well, that's a good question, Carson. Potentially retail investors, and there's no answer to that at the moment. I mean, so far we've seen the securities falling as investors stand to fill the gap. But what we're saying is that these securities represent excellent value and an opportunity for investors to get set in these securities while other institutions are forced to sell down them.
We're talking about yields in the vicinity of, what, 9%, so very attractive. You do believe there's enough knowledge out there in the marketplace of what's on offer. Tell me about the ANZ issue.
Well, the ANZ issue might come under some pressure now. When we spoke about that last week, it was offering 3.1% over, and that hasn't changed because it hasn't yet listed. Whereas a number of other securities, since they've been selling off in price, are now offering better returns than the ANZ CPS2 security.
What's going to happen, though, if those yields have to stubbornly remain at that point? I know you're of the view that they won't, but I guess it's all swings and roundabouts, and the banks may eventually decide, well, look, this is not an option that we can really afford to be going down.
Yeah, what will happen then? I mean, we think the ANZ CPS issue will still get away. What we were thinking is that it's probably issue at a small premium, probably around $102, $103. If yields stay where they are now, most of the other what we call converting preference share issues are trading similar to about 3.1% margin. So we'd expect the ANZ issue to come on around par at this stage.
Let's move into the corporate space, the corporate hybrid space. Multiplex you're eyeing. An attractive entry point there for investors, or what's playing out?
Yeah, Multiplex is an interesting one. It's actually a security that has risen more than 4 times in the course of this year. You could have picked it up earlier this year for $18. It's now trading around $75. And even though it's more than quadrupled in price, we still think it represents good value. This security has a potential redemption date on 1 April next year. And if the security doesn't get redeemed at that point in time, the margin or the coupon margin will increase to 3.9% over the bank bill swap rate, which we think is quite an attractive return for a security that is backed by an A- rated property investor such as Brookfield.
Well, that almost seems as safe as houses, but there must be some risk.
Oh, there's always risk in these securities. I mean, property trusts have come under a lot of pressure in the last 12 years the last 12 months with the devaluation of a lot of their property holdings, and we think that is putting pressure on the whole sector in general. What most people seem to have underestimated is the general deleveraging of these property trusts, and underestimating also the impact of having Brookfield, in this case, as a backer of the multiplex sites.
Brief and final thought, any other hybrids on your radar?
Yeah, we also like another security issued by Paperlinks. Now, Paperlinks is a company that has had a considerable amount of difficulties in the last 12 months in trading conditions, and it has also breached its banking covenants. On the flip side, it has recently, or at the start of the year, managed to sell its major Australian plant manufacturing operations, and it now has next to negligible net debt, and it has a very strong, what we call, working capital position. That is inventory and receivables, less payables. And we think it should be able to overcome these problems, and it represents very attractive value at current levels around $45.
Brad Newcombe, we must leave it there. Appreciate that insight. We'll talk soon.
Excellent. Thanks, Carson.
All right. Brad Newcombe from